Every year, the world's economic power map gets a major facelift, countries rising, others stabilizing, and some slipping behind. It's a high-stakes game of growth and influence. So, who's winning in 2026? And what does it really mean for investors, businesses, and economic developers? Stay tuned, because in this video, we're breaking down the global economy in one chart, revealing the winners, the challengers, and the opportunities shaping the future of global power. Let's dive in. The significance of GDP rankings in a changing world. Gross domestic product, GDP, remains the most straightforward indicator of a country's economic size, and by extension, its market potential, investment attractiveness, and geopolitical influence. While GDP alone doesn't guarantee success or prosperity, it provides a crucial context for understanding where demand is strongest, where supply chains are anchored, and where long-term growth prospects lie. For investors, the top-tier economies are often the first targets for expansion due to their large markets, deep capital pools, and stable governance frameworks. The 2026 Global Economic Landscape, an overview. The global economy in 2026 is set to move forward with a measured, somewhat subdued rhythm. Growth, while ongoing, is no longer broad-based or evenly distributed. Instead, it is increasingly concentrated in a select group of dominant economies, with many others vying for position within shifting supply chains and investment networks. Three main forces shape the 2026 landscape. 1. North America's dominance. With its deep capital markets, technological innovation, and consumer strength, North America remains the core financial and demand hub of the world economy. The United States, in particular, continues to lead, anchoring the region's economic power. 2. Asia's ascendancy, driven by scale, demographic trends, manufacturing capacity, and rapid technology adoption, Asia's share of global output continues to grow. Countries like China and India are at the forefront of this rise, transforming into global economic powerhouses. 3. European stabilization. Europe stabilizes but faces structural headwinds, demographic stagnation, energy transition costs, and productivity slowdowns. While it remains a significant player, its growth pace is more measured. This tripartite dynamic creates a more polarized global economy, where a handful of economies pull further ahead, leaving others to adapt through specialization, collaboration, or repositioning. The top 25 economies in 2026. A strategic breakdown. When examining the top 25 economies, it's clear that these countries dominate global output, nearly monopolizing foreign direct investment, FDI, flows. These economies are not only large in size, but also central to global supply chains, technological innovation, and consumer markets. The top 25 can be grouped into three tiers: powerhouses, core economies, and high-growth and strategic climbers. Tier 1, the global powerhouses. United States, approximately $30 trillion. As the undisputed leader, the U.S. continues to wield unmatched economic influence. Its strength lies in consumer spending, advanced technology, and innovation ecosystems spanning tech, aerospace, and energy. Key sectors to watch include semiconductor manufacturing, clean energy infrastructure, and high-value reshoring driven by automation and AI. The U.S. remains the primary destination for global capital, with a resilient financial system and a large, sophisticated workforce. China, approximately $20 trillion. Despite moderating growth, China's manufacturing superpower status remains intact. Electronics, batteries, electric vehicles, and industrial machinery are central to its dominance. Its supply chain gravity is formidable, and it is increasingly exporting EVs and batteries, reshaping global automotive supply chains. Economic developers should monitor outbound FDI as Chinese firms diversify their production footprints and invest more strategically abroad. Germany, approximately $5 trillion. Europe's industrial engine, Germany, continues to lead high-value manufacturing sectors such as automotive, machinery, and chemicals. As Europe invests in energy transition and automation, Germany's role as a supply chain hub and innovation leader remains vital. Its stability and advanced infrastructure make it a magnet for capital in the high-tech manufacturing space. India, approximately $4.5 trillion. India stands out as the fastest climbing major economy, driven by demographics, domestic consumption, and digital infrastructure. Its growth trajectory makes it a key player in electronics, semiconductors, and logistics. As policies favor industrial expansion, India's evolving manufacturing landscape offers significant opportunities for FDI, especially in assembly and supply chain development. Japan, approximately $4.4 trillion. Japan maintains its reputation for precision manufacturing, robotics, and advanced technology. Its focus on factory automation, medical devices, and aging population solutions positions it as a strategic partner for high-tech supply chains. Japanese firms are increasingly offshoring mid-tier manufacturing into ASEAN, further integrating regional supply networks. Tier 2, core industrial and consumer economies. United Kingdom, approximately $4.2 trillion. Post-Brexit, the UK is pivoting towards a services-led economy, emphasizing finance, life sciences, and advanced services. Infrastructure modernization, fintech, and green energy are key sectors for future growth. Its strategic position as a gateway to Europe remains vital for logistics and trade. France, approximately $3.5 trillion. France's diversified economy spans aerospace, energy, luxury goods, and manufacturing. Defense and hydrogen economy initiatives are prominent, alongside investments in transport infrastructure, a vital component of Europe's supply chain resilience. Italy, approximately $2.7 trillion. Italy's high-value manufacturing, especially in fashion, machinery, and automotive components, continues to be a key export sector. Automation upgrades and reshoring efforts are vital to maintain competitiveness. Russia, approximately $2.5 trillion. Russia's economy remains heavily reliant on commodities, especially energy. Geopolitical dynamics influence its trade and investment flows, with a focus on energy logistics and regional trade realignment. Canada, approximately $2.4 trillion. Rich in resources, Canada's focus is on critical minerals, EV manufacturing, and clean energy. Its stable institutions and North American integration position it as a key resource and innovation hub. Brazil, approximately $2.2 trillion. Brazil's strength in agriculture, energy, and mining sustains its role as Latin America's economic leader. Technological innovations in agribusiness, port infrastructure, and renewable energy are opportunities for future FDI. Spain, approximately $2 trillion. Spain's growing services and tourism sectors, along with renewable energy initiatives, are attracting attention. Logistics hubs and manufacturing relocations from Asia are also playing out. Mexico, approximately $2 trillion. As North America's nearshoring hub, Mexico is central to automotive, electronics, and medical device manufacturing. Its proximity to the U.S. market offers strategic advantages for supply chain resilience. Australia, approximately $1.9 trillion. Australia's resources, lithium, rare earths, and critical minerals, are vital for the energy transition. Its role in Indo-Pacific logistics and energy inputs is expanding. South Korea, approximately $1.9 trillion. A leader in semiconductors, batteries, and digital manufacturing, South Korea is pivotal in the chip supply chain and AI hardware development. Turkey, approximately $1.5 trillion. Positioned as a manufacturing and trade bridge between Europe and Asia, Turkey's automotive, machinery, and textiles sectors are poised for growth, especially as logistics corridors expand. Tier 3, high growth and strategic climbers. Indonesia, approximately $1.5 trillion. Southeast Asia's largest economy, Indonesia, is emerging as a manufacturing hub for battery materials and EV supply chains. Its resource base and strategic location make it a key player in regional supply networks. Netherlands, approximately $1.4 trillion. Europe's logistics and trade gateway, the Netherlands, benefits from port-driven FDI, data centers, and advanced agricultural technology. Saudi Arabia, approximately $1.3 trillion. Transitioning from an oil-dependent economy, Saudi Arabia invests heavily in industrial gigaprojects, clean hydrogen, and logistics infrastructure to diversify its revenue streams. Poland, approximately $1.1 trillion. Eastern Europe's manufacturing growth engine, Poland, attracts automotive, logistics, and industrial investment, especially near its borders with Western Europe. Switzerland, approximately $1 trillion. A capital-dense economy, Switzerland excels in finance, pharma, and high-value exports, emphasizing advanced materials and biotech. Taiwan, approximately $950 billion. As the global epicenter of semiconductors, Taiwan's chip fabrication and advanced packaging are critical for geopolitical and supply chain security. Belgium, approximately $760 billion. With its port of Antwerp, Belgium is central to EU chemicals, energy, and logistics sectors, making it a strategic hub for European supply chains. Ireland, approximately $750 billion. Ireland's FDI density, especially in tech, pharma, and financial services, positions it as a European gateway for US and global firms. Sweden, approximately $710 billion. A leader in innovation, Sweden's focus on batteries, EV supply chains, green steel, and decarbonization aligns with global sustainability goals. The regional and strategic implications. Beyond individual country rankings, the geographic distribution of economic power shapes global supply chains and investment strategies. Asia remains the primary growth engine, with manufacturing depth and rapid technology adoption fueling its rise. North America continues to be the capital and demand hub, attracting nearshoring and advanced manufacturing investments. Europe focuses on high-value, capital-intensive sectors, emphasizing innovation and sustainability. Latin America and Africa are resource-rich regions, with growth opportunities in commodities and digital economies. The Middle East is diversifying away from oil towards infrastructure, energy, and logistics. The future is now. The 2026 global GDP landscape underscores a world in transition. While the largest economies continue to dominate, emerging markets and strategic climbers are rapidly gaining ground through innovation, infrastructure, and policy reforms. For economic developers, the challenge and opportunity is to harness these signals, prioritize readiness, and position their regions to capitalize on the next wave of growth. The world's economic map is changing, and those who read the signals early and act decisively will shape the future of global prosperity. Are you prepared?